Hi, Brandon Davis with Davis CPA Group. I'm going to talk to you guys a little bit today about corporations and the taxation of corporations and S corporations versus what they call C corporations. So we're kind of jumping into it. A corporate structure is one that allows you to have a separate entity, separate from you as the owner. I've talked in the past on videos about sole proprietorships and LLCs and what those mean. Well, a corporate structure is one that allows you to have some protections, liability protections inside your organization, and also gives you some formal structures to have multiple shareholders, officers, boards of directors, and all those that can help you govern the entity. So we'll kind of jump into it here. So a corporation, which is what we're talking about today, is an entity that we see a lot of. And two options or two questions I get a lot of times are, what type of corporation should I be? Should I be an S corporation or C corporation? And you ask yourself, well, what's the difference? Well, we're going to go into that. It's all about how they're taxed. From a standpoint of structure and legal formation, they're basically the same. And an attorney can help you get the bylaws set up, your articles of incorporation with the Secretary of State filed, establishing your board of directors, all the legal stuff that you need to make it a corporate and legal entity. You know, one thing that I like to talk about too when I'm talking to my clients about using a corporate structure or setting up any type of legal entity is respecting that entity. Because the whole purpose of setting it up in the first place is making sure that you have some level of legal protections. Well, if you set up a corporation and you open up a bank account for this corporation and then you spend all your money that you earn inside the corporation on your personal assets and don't take wages and do formal things to preserve the entity, then you might as well not even have it at all. And a good attorney is going to say, well, you've not done a good job in protecting and preserving that entity structure, and so if there's a liability claim that comes against a corporation, you may become personally liable for not doing things properly. It's a little side note in why you want to preserve and respect the entity structure. Well, let's say you get past that hurdle and you're going to do that. Now let's talk about what structure would make the most sense from a taxing perspective, and kind of what are those two options. So again, we've got an S corporation structure, S corp here, and a C corp structure. An S corp structure is one, and S corp is basically subchapter S of the Internal Revenue Code that talks about corporate structures. And this entity structure it starts with a corporation taxed as a C corporation or pays its own tax, and you make an election by filing the form 2553 with the IRS to choose to be taxed as an S corporation. And that selection or that choice basically means that the corporation does not pay its own tax. So there's no corporate tax. Instead, what happens is all of the income and loss from the corporate tax return flows to your personal return. So personal return, or the owner's return might be a better way to say that. C corporations, they pay tax. They also are set up such that some of the tax advantages or different tax rates that you might see in types of income from a standpoint of capital gain, ordinary income, some of those things, those different gain rates and income tax rates don't apply to corporations. So the tax rates are different. And what's interesting is, we're making this video in 2018. We just got a whole bunch of new tax law changes that have changed this whole dynamic. In the past, both individuals and corporations had graduated tax rates. Well, these new tax law changes, the only corporate tax rate is 21%. It's a flat 21% tax rate. Whereas individuals have graduated tax rates still. And so what happens is, one of the things we got to look at from these two perspectives is a couple of things. S corporations are generally smaller businesses, smaller corporations. They have a limited number of shareholders that you can have. There's limited types of shareholders you can have. We can get into those details if you want to meet and discuss those as a prospective client. But there are some caveats you've got to consider. The thing I want to focus on today is primarily just the different taxing structure. And so C corporations are such that, again, they pay a flat 21% tax. And so, and there's no capital gains taxes. And so if you've got a business type that you might have some appreciating property or things that you can sell with capital gain type income, which is income where you buy an investment or hold something that appreciates in value, you sell it at a later date, it's not an ordinary or an operating part of your business. Well, individuals have capital gain rates. And so the top individual rate from an income tax perspective is a little bit different than from a corporate perspective. And so you can have a 15 or 20% capital gain rate, and then you have the graduated ordinary income rates that we've got to deal with. So we'll take this now and let's talk through and actually look at an example. So you might be saying, all right, I got a corporation over here with a flat 21% tax rate. And so if that's the case, but I've got graduated rates, up in the high 30s for my individual taxes, well, why wouldn't I want to be a C corporation? Well, maybe you do want to be a C corporation, but we've got to talk through some other things that I've got to share with you that might surprise you. So if I've got a business, let's say I made $100,000, and let's just call this ordinary income. We won't talk about capital gain versus ordinary income and different tax rates, what have you. Just call it all ordinary income, so we're playing with the same types of income in both entities. So if I have this 100K in income on both entities, okay? I've talked about in previous videos the need to have reasonable wages in an S corporation, meaning you have to pay yourself some type of wage. Similarly with a C corporation, you're going to want to pay yourself a wage also, because as we kind of come down here to the bottom, you're going to find out something about double taxation of a C corporation, and maybe that's something you've heard before, and we're going to kind of get into that. But let's say, for example, then we pay ourselves $25,000 in wages in both of these entities. Because wages are deductible on both corporations, and then we get a W-2, and we pick that up on our personal return as income. Those are ways to get income out of a corporate entity. There's other ways too, but we're not going to get into all those today. So we have wages here that are to me, and then I've got another, let's say $25,000 in just operating expenses, and they're similar for both, whether it's rent or payroll for other employees or what have you. So that leaves us $50,000 in profit. Well, this $50,000 here is going to go out to my individual return via Schedule K1, which is a schedule that's generated inside an S Corp return. It's going to go out to my personal return. I'm going to pay tax on that, $50,000 plus my $25,000 in wages and whatever my tax bracket may be. And that's going to be dictated by my marital status, kids, number of other sources of income, what have you. But we're just kind of keeping it simple here. On the C Corp side, the corporation is going to pay its own tax. And with these new tax rules, and we're going to ignore the state rates for now, I'm talking about just the corporate rates, it's going to pay tax at 21%. So I've got tax I got to pay here, and I've got no tax I'm going to pay here. I'm going to pick up the $25,000 in wages on my personal return and pay that at whatever tax rate I'm in, and 21% on the $50K here. Well, one thing that's kind of neat in S corporations is I can take this $50,000 out as what they call distributions to myself. And it's not taxed because I want to pay tax on that $50K anyway. If I want to take distributions of this $50K out that's been profits in the C corporations, I want to be taxed again because this is going to be what's called a taxable dividend. And so that's the kind of the catch here. And the dividend tax rate, and it's going to be what they call a qualified dividend, is going to be somewhere around 15%. So you can see that if, say, for example, over here, I have an effective tax rate of 15 to 20% on the personal return, and I pay 20% here and 15% here, you're really not any better off being a C corporation. In fact, you can find in certain instances, you may be paying more tax with this double taxation structure. Now, I will say C corporations do have their place. And again, it comes back to the types of owners that are going to be part of the C corporation, the number of owners you're going to have. And one of the things that we like to look at Davis CPA Group in particular, is the most tax efficient structure that we can come up with. So I've got some clients that currently are C corporations. We pay tax at the 21% bracket because they keep income and they keep profits inside that corporation and don't need to take them all out. Well, if that's the case, maybe I'm more tax efficient to do that, and we're not going to change it just for the sake of change. So this is just something to think about whenever you're looking at a corporate structure, to be able to look at and make sure you run the numbers fully to figure out what's the better answer for you.